This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Japanese stocks are set for gains after the yen fell the most in 2 years on dovish signals from the new Prime Minister and the BOJ Governor. Treasury slip as strong jobs numbers curb bets on another jumbo Fed rate cut. Oil climbs a third day as President Biden says Israel should not target Iran's nuclear sites. The G7 holding emergency talks on the escalating Middle East conflict. And OpenAI raises $6.6 billion in new funding, investors including Microsoft and Nvidia giving it a valuation of $157 billion. We do have some breaking news just crossing the Bloomberg when it comes to composite PMIs out of Australia at the moment. The Judo Bank Australia PMI composite number coming through. This is the final September reading, I should say, that we are just getting now, 49.6. So slipping a little bit further into contraction from the prior reading of 49.8. We're also getting that PMI services number, the final reading at 50.5. So still above that level that suggests some amount of expansion, but also pulling back a little bit from the reading of 50.6 that we saw in the previous month as well, Shery. So this, of course, as we continue to monitor any further signs that we might see an inclination for the RBA to move a little bit quicker as we see, of course, that hawkish hold still prevailing. Some of the latest data that we saw when it comes to retail sales really suggesting that it is still pretty resilient when it comes to the Australian consumer, with that spending being boosted most recently by tax cuts as well as some of the warm weather records that we've seen being set in Australia.
And Haidi, it could be a hold also for longer here in Japan. I mean, we are on yen watch again because of really those weakening moves, especially after more confirmation that the new Japan administration plus the Bank of Japan may be on the same page when it comes to really not rushing into hiking rates at this point. But it was really what was on the other side of the trade, with the U.S. dollar also jumping overnight, that caught our attention. It was the ADP private payrolls numbers rising more than expected. In fact, if you take a look at U.S. data recently, it's been surprising to the upside. And we had U.S. job openings yesterday just rising to the highest level in 3 months. The non-farm payrolls on Friday will be key, especially with the Fed's focus now on the labor market.
And of course, we're continuing to watch the geopolitical tensions continuing to play out across the Middle East. And we're seeing the US sort of, again, trying to be the voice of deterrence here when it comes to further moves potentially from Israel. President Biden really, I guess, issuing a little bit of a warning when it comes to further attacks from Israel to Iran, attacking the prospect or the concern, of course, is that Iranian nuclear facilities might be the next target there. We have really seen kind of some warnings when it comes to potential retaliation again from Iran as well. Netanyahu has vowed that reprisal against Iran after that barrage of missiles that we saw earlier in the week. But President Biden saying now that Israel should hold off from attacking nuclear facilities in retaliation for that, as G7 nations at the same time are also seeking to try and tamp down on what has become really a spiraling conflict that ever more threatens to pull the US even deeper in at a time where, of course, Shery, we've seen kind of a very limited influence that Washington has been able to have. Biden was asked whether he would support such a response, and he said that the answer is no. He's set to speak with Netanyahu a little bit later, as well as that planned statement from the G7 as well, with potential further sanctions on Iran.
Yeah, and the implications of potential disruptions in the oil markets really boosting prices at the moment. We're seeing WTI now gaining ground for a third consecutive session. It was really trying to figure out what's happening with the oil markets, with geopolitical tensions that led to not a lot of movement when it comes to U.S. stocks. Right now, futures pointing slightly to the upside, but it was just a marginal move in the overnight session, trying to gauge what's happening with the U.S. labor market as well. What we really saw was the Treasury yields gained ground, of course, after the stronger than expected data, and that led to the dollar seeing its highest jump and the highest levels in about 2 weeks. On the other side of the trade, take a look at how we're setting up in the Asia session, because we could see more gains for Japanese stocks given those losses in the Japanese yen. And that move was really interesting. After we got the ADP private payrolls data, we saw really the yen rallying or weakening past that 146 level against the U.S. dollar. It was already at around 144 after the new prime minister's comments on the BOJ rate hiking path. But really, those two moves combined really sending the yen down against the greenback again. And of course, the offshore yuan holding steady at the moment, Korea away on holidays. Our next guest is expecting another 50 basis point rate cut from the Fed in November. Let's bring in Terri Spath, founder and CIO at Zuma Wealth. Terri, great to have you with us. How are you seeing the U.S. labor market? Are we pricing in too many Fed rate cuts given the new trajectory of this economic number?
I think you guys have covered some great number of risks of what's going on just globally in investors' portfolios. Everything that you covered, I thought was just fascinating. And one of which, as you talked about, there's this risk right now of inflation rearing its head again here in the U.S., right on top of when most people are expecting the Fed to continue its cutting cycle. I think they probably will cut in November, as you mentioned, even though, they'll continue to collect data. And I do think that there's some risk that we've got some inflationary pressures, as you talked about, with tensions in the Middle East, pushing up oil prices. I think that we're really going to see some risk for inflation with the payrolls number, as you pointed out, being a little bit stronger than expected. At the same time, with this sort of trajectory for the Fed wanting to cut rates, it's going to be a tough one for them come November. I do think they end up cutting, despite the fact that I think we could see some risk to inflationary pressures to the upside in the next couple of weeks.
And I haven't even gotten to the dock worker strike across the U.S. right now, right? How do you position in the markets if you're factoring in potential inflationary risk?
Yeah, I think it's tough. I mean, you highlighted the dock workers strike, and I do think that that's something that's not quite getting as much coverage as you guys are giving it right now, and it's less understood. We're only, I think, 2 days into this dock strike, but it could very quickly turn into a big problem for a lot of companies here in the U.S. We've got, this strike is impacting docks from, I think, Texas to Maine. If they have docks in Maine, we don't have it here in California yet. But this could very quickly cause disruptions in business operations, hits to earnings, and also cause inflation because of shortages of goods. And I think that's something that could contribute to some risks here in the U.S. And it's why we're really emphasizing some of these markets that you were just talking about in Japan, for example, where it's going to be probably less risk and a little bit better return for investors, because I do think that this dock worker strike, politics, potential inflation risks because of the Middle East are all going to hit the U.S. a little bit harder than other areas around the globe.
We haven't even gotten to China yet. And Terri, as you mentioned, we do really need to talk about it. I want to throw up this chart to take a look at just how speedy we've seen the reversal of fortunes when it comes to Chinese risk assets. And part of this obviously is because they were coming off such cheap valuations. But until 3 weeks ago, China was last in this group across the MSCI. That is now coming in first. It's really kind of a world-beating rally. I guess the question is how sustainable this is. And do you see this as a reflation risk sort of globally, or at least a sustainable, turnaround when it comes to how you view Chinese assets right now?
Yeah, we do have to talk about China. So I'm glad you brought that up, because it was an area that we, as well as many others, have been quite negative about for a long time. But these massive stimulus measures that have been unleashed in China have really resulted in the sharp and kind of a nosebleed rally in Chinese stocks and stock markets. And all the changes are good. They're good, positive changes, sweeping stimulus measures, rate cuts, lower mortgage rates out of the banks, a range of monetary easing. I mean, a lot of injection of capital to encourage lending. And the way that investors can play that is through ETFs, such as a ticker MCHI, that's iShares for China, PGJ. Those are good ways to participate. But as you pointed out, it's been a huge rally in a very short amount of time. RSIs are really high. So I do think that investors can buy right now, because relative to where these stock prices were in the past few years, we're still below that. And you're going to have the opportunity as well. There's going to be pullbacks in these stocks. Whoever comes into office in November, they're going to be negative on China. So you'll see some pullback, but you can also participate today and just sort of leg in.
Yeah, and how do you get that exposure? What's your preferred avenue through here?
I think either of those ETFs, that iShares MSCI China, that gives you a more diversified approach to participating in the rally there. PGJ, that's the Invesco Golden Dragon ETF. Both of those have really good exposure to mid and large cap stocks in China. They've had huge runs, as you pointed out, but are still quite a bit below where they were in years past. So they still have opportunities to run, and also pay attention. There will be pullbacks, so you'll get some more chances between now and year end as well.
Terri, you mentioned the favorable environment, for example, for Japan. Where do you find exposure at a time when we really don't know the direction of the Japanese yen?
Yeah, we don't know the direction of the Japanese yen, but we probably often don't. And if rates go up in the US, which they might, if there's inflationary pressures, then that's going to pressure the yen. But we don't necessarily see that. We do think that maybe there's some short-term inflation numbers, but the trajectory for the US interest rate environment is to the downside. That's going to favor the yen. And so we just think investors should make sure that they have some exposure, because still, even with the nice run that we've seen in Japan, we're still underweight in most investor portfolios, probably in your viewer base. And so make sure to at least have a market weight just through a general ETF that represents that country, and you'll be able to continue to participate in what we think will still be over the medium term strength for the yen going forward versus the dollar.
Terri, great to have you with us. Terri Spath, founder and CEO at Zuma Wealth. Coming up on the Asia trade, we'll be talking volatility across oil markets. Invesco and Vanda Insights join us as the conflict in the Middle East escalates. Plus, we'll be joined by CLSA's Oliver Matthew to discuss Softbank's investment in OpenAI and the broader outlook for the Japanese AI ecosystem. This is Bloomberg.
Iran's missile strike were a necessary and proportionate response to Israeli continued terrorist aggressive acts over the past 2 months. The regime is pushing the region to the edge of an all-out, unprecedented catastrophe. Israel has no intention to pursue peace or a ceasefire.
Iran's ambassador to the United Nations is speaking to the Security Council on Wednesday. Well, Bloomberg's Michael Heath joins us now for more on the latest. And it's quite interesting. If you listen to, what was kind of said, they were sort of forced into necessary retaliation, if you will. And it does sort of play into this, perhaps, analysis that, it was a sort of consistent missile attacks from Israel that really, I guess, forced Iran's hand in responding here.
Yeah, I think it's a bit of a spurious argument. I mean, Israel hasn't bombed Iran. Israel's fighting a separate state, Lebanon. It's not fighting Iran. We know that Hezbollah is backed by Iran, and Hezbollah is heavily armed and financed by Iran. But Israel hasn't been firing missiles in there. It did presumably assassinate the head of Hamas in there. But I think that, this is the second attack by Iran. And while the first one, they gave plenty of warning, they sort of almost wanted the US and Israel to shoot down these missiles. They were faster missiles this time. And it's very easy to sort of look at this as like a video game. You see it and it's computer generated and or you see the missiles going across on social media. But 200 missiles is seriously destructive, and it's an act of war, basically. It's very difficult to call it otherwise. So I think this notion that Iran's just responding and it's been showing restraint, given Hezbollah's been firing into Israel every day for a year now, I think it's hard to maintain that argument. I mean, there's fault on all sides, definitely, but Israel, in many respects, if and when it responds, it does have a very good claim. It's just defending itself there.
And Netanyahu has said that he would respond for the missile strikes. It's interesting we're seeing sort of Washington trying again, perhaps, with limited influence to try and try and talk down the tensions. I mean, Biden has not had a lot of success on that front.
He hasn't. No, it's very true. And I suspect when it comes to state-to-state conflict with Iran, I suspect that Biden will be more influential there. It's one thing when you're talking about southern Lebanon or Gaza. These are localised areas. Israel has them very well penetrated with intelligence and that sort of thing. And it has a better better judgment of the risks and rewards there. With Iran, you know, we know it's a state that's probably fairly close to having a nuclear weapon. It hasn't pushed on with that as far as we know at this stage. I mean, the stakes are very, very high there. And Iran obviously has, you know, backing with China and relations with Russia and all this sorts of stuff. And if Israel does get embroiled in some sort of, you know, God forbid, in a war with Iran, the US will be dragged into that. So I think Netanyahu's going to have to be a lot more cognizant of what Biden and the US thinks there.
And now we have Hamas also claiming responsibility for the shooting and stabbing in Tel Aviv earlier this week as well. Mike, this just continues to escalate.
Yeah, Shery, and that's exactly right. And I think it's tragic, but it's going to be something we see more of as Israel has degraded Hamas's, you know, its conventional weapons in terms of missiles or rockets or those sorts of things. These groups like Hamas are probably going to end up going back to where they sort of began, which was terrorist attacks or lower scale violence like this, because they've almost become like, I mean, Gaza in a sense was a state, a mini state in a way, self-governing. They almost have become like states there, and these fights have become sort of army to army. But if this is what they choose to do and return to that, then it becomes very difficult for Israel to counter and very difficult, you know, to manage security within Israel as well. And this is the other thing, just going back to Iran too, that's another possibility. If they choose not to respond again to Israel, that, you know, there's been terrible attacks on Israeli embassies and other outposts in the past that will have to be very carefully monitored there too. So this is a new worrying development, definitely.
Bloomberg's Michael Heath there with the latest on the Middle East. Now, other stories that we're following at the moment, the U.S. Central Intelligence Agency is boosting efforts to recruit Chinese citizens. The agency hopes to capitalize on what officials say is growing discontent with President Xi Jinping. The CIA has issued Chinese language instructions on social media, detailing how people can securely contact it on its public and dark websites. The move comes as Washington struggles to gain insights on Xi's inner circle. Canada says it's working with Nordic countries to create a new Arctic security coalition. Foreign Minister Melanie Joly told Bloomberg that talks are needed because the Northern allies don't meet at the political level anymore, partly due to Russia's presence on the Arctic Council. Joly says the Russia-Ukraine war and China's interest in the far north are a new reality for Canada. We have more ahead on the Asia Trade. This is Bloomberg. You're watching the Asia Trade. Apollo CEO Marc Rowan says he doesn't see a reason for the Fed to keep cutting interest rates right now, warning the U.S. economy risks becoming overstimulated. Speaking exclusively with Bloomberg, Rowan also outlined his concerns about economic management ahead of the presidential election.
The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
Do you see anyone on the campaign trail that's willing to do anything about that?
On the campaign trail, no.
In reality?
Let's hope. All we can hope for is better governance.
I've said repeatedly on Bloomberg surveillance, on Bloomberg TV, on Bloomberg radio for years that America has the privilege, the unique privilege of acting recklessly. Are we losing that?
Not yet. We have a long way to go. We have lots of examples around the globe of people who have acted recklessly for a much longer period of time than we have been acting recklessly. But we also have obligations that others do not. Right now, we are the beneficiary of being the strongest economy, the strongest capital market, the strongest military, and the best place to do business. I mean, if you tick off what's happened over the past years here, we may not like how we got here and how we financed it. 3 years ago, we decided to build infrastructure. We allocated $2 trillion. None of that's built yet. It's all being built. 2 years ago, we spent $52 billion of semiconductor subsidies to build semiconductors here. Not a single plant is open. It's all being built. A year ago, Inflation Reduction Act to encourage the manufacture of renewables. 1.3 to 2.3 trillion. No one really knows. Not a single plant is opened. We are the beneficiary and the largest recipient of foreign direct investment 3 years in a row. So people around the globe are actually figuring out we're better off here. And something tells me we're ramping defense production. All of those things are fiscally stimulative and positive for employment. Oh, by the way, we have no illegal immigration. This sets us up very well fiscally for a strong economy, which I think we're seeing.
Federal Reserve is cutting interest rates by 50 basis points. Are you in Torsten's lot camp? And you can agree or disagree with Torsten, of course. Torsten works here. He believes this economy doesn't need rate cuts. We're in a great place. Do you share that view?
I said it right. I was, I guess, unfortunate to be on TV an hour after the rate cut. And I said this was a very, very expensive insurance policy.
What's expensive about it?
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet we're stimulating. And we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time. And to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter, to the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now.
Apollo CEO Marc Rowan there speaking exclusively with our colleague Jonathan Ferrer. Time now for morning calls ahead of the Asia trading day, and Scott Robnow of Goldman Sachs says a rally in US stocks may push the S&P 500 above his own year-end target of 6,000. The firm's managing director for global markets says his target may be too low as seasonal headwinds failed and stocks tend to rally after US presidential elections. But Robnow also added that he remains tactically bearish on US equities in the next 3 weeks. Bank of America's Bernard Mensah says that interest rates in many parts of the world won't likely return to pre-pandemic levels. He's citing challenges plaguing the global economy, such as geopolitical conflicts and changes in supply chains. Mensah says economies need to focus on long-term trend growth instead of just relying on monetary policy.
I personally have been worried about just the underlying inflationary pressures that are out there for a bunch of reasons, whether it's COVID, whether it's supply chain moves, and the inflation shocks going through the economy. We have the port strikes in the US that are happening now, and we have increased wage demands. My instinct has been that all of those things add inefficiencies in the system, and as we're moving to a different, perhaps, type of globalization, that we might find that the underlying trend inflation rate is a little bit higher.
Take a look at what we're watching when it comes to Aussie bonds at the moment, and we did have some PMI data out a little bit earlier showing really a mixed picture when it comes to some weakness across that composite number, but perhaps overall resilience when it comes to services. Bond yields are extending the rise at 10-year up 6 basis points to just over 4%, and they are really on track, expected to follow what we saw in Treasuries lower, that ADP jobs report prompting concerns about Fed expectations.
We could see Japanese stocks rebound at the open in about half an hour. We had seen it fall more than 2%, but the Japanese yen has renewed its weakness. Now it's topping 146 per dollar at the moment. Of course, we had more indications that the new government and the BOJ are on the same page when it comes to not rushing in hiking rates. We'll also be watching Softbank. It rebounded already this week. It's been helped by participating in that OpenAI funding round. Sydney futures at the moment not doing much, Haidi, but of course we'll be watching commodities today.
We have seen so much action, right, and that doesn't look like it's going to be ending in terms of some of the thematics that we're watching for commodities. There's a China story, of course, and we have seen that big spike in iron ore after some of those top Chinese cities eased home buying curbs, and seeing those gains actually continue after iron ore prices took a bit of a breather. And we're seeing broadly based metals really extending that rally as the industry gathers for LME week. We're watching copper there as well, holding on to most of those gains in the wake of those China stimulus measures. And again, those broad sort of advances across commodities there. And of course, China is still in the midst of a week-long holiday. We've seen copper up about 10% over the past 3 weeks alone. But the big one that we're watching is really any particular moves in the energy market. New York crude is trading up by just over 1% at the moment. We're seeing a gain for the third straight day. Traders still really assessing the supply risks that are playing out across the Middle East. Israel is expected to make a retaliatory strike against Iran following Tehran's missile barrage earlier this week. And we know that President Biden, as well as G7 nations, are really hoping to sort of influence that situation and tamp down on some of the escalating conflict. But let's talk about the scope of geopolitical risk here and the risk to broader supply when it comes to oil. Vanda is the founder of energy market intelligence provider Vanda Insights. Vanda, great to have you with us. And, you know, certainly precarious times for oil trading at the moment. And for a long time, it's interesting, it felt like markets were really shrugging off escalating geopolitical risk. A lot more kind of bearishness on the China demand side of the story, the global growth side of the story. Do you think that mentality has changed over the past week?
Good morning, Haidi. So, yes, I think what changed the calculus on the geopolitical front was, of course, the attacks by Israel on the Hezbollah, and including a ground assault in recent days. But even more than that, the Iranian missile attack on Israel. Now, throughout these past few months, since October 7th of last year, we've seen a lot of saber rattling, a lot of rhetoric from Israel, exchange between Israel and Iran. But the only direct attack on each other's territory that we've seen was in April. And what the lessons that market has taken away from the events of this April is that, when both sides did attack each other with very limited, no casualties, almost choreographed to ensure that there wasn't much damage, and as a result, no further escalation. What the market has taken away from that is that both the sides are very keen to avoid things spiraling out of control, and certainly other regional governments stepping into this war. And definitely there is a sort of a baseline assumption in the oil markets that Iran particularly will do anything to avoid a direct military conflict with the US. So that's why you see geopolitical risk premium creeping into crude, but nothing that would correlate with perhaps the worst case scenarios.
Is there a concern over a blockade from Iran's side, or a concern over the attacking of Iranian facilities from Israel's side?
So that is among the worst case scenarios that the market is having to sift through right now. Now, I did note that in the media reports, it was an unnamed, anonymous Israeli official who said that we may attack oil facilities in Iran. So really, it's hard for the market to, again, you go back to the base case, that the base case being that Israel would not do anything that that prompts things spiraling out of out of control, a sharp escalation, and an attack on Iranian oil facilities would certainly be one of those. Similarly, time and again, through history, Iran has threatened to block the Strait of Hormuz. Again, let us remind ourselves it has never actually done that. That also I put in the similar category that Iran will refrain from. We haven't even seen the threat crop up again, so Iran will refrain from that. So again, as I said, the baseline remains that they will avenge, exact revenge, but stop just short of causing damage to the extent that makes things much worse.
So does that change the supply calculus at all at this point, given, of course, that we're also factoring U.S. stockpiles rising, not to mention at the same time what OPEC Plus is doing?
So on the fundamentals front, of course, the market has to assess what is the risk, realistic risk of supplies from the Middle East getting affected. At this point, that's really minimal. It's a tail risk, if at all. In terms of and then, of course, it has to look at the fundamentals, right? What are the inventories doing in the OECD? And definitely there is a focus on U.S. inventories, especially because crude inventories have been draining down quite sharply, sitting at year lows in the U.S., which is not a good situation if the worst case scenario in the Middle East should unfold. But otherwise, I would say the inventory levels are not anything to cause an alarm or cause a rally in crude prices on their own. And then, of course, again, I think the focus remains on demand, and quite a pessimistic view of demand, certainly in China, but definitely in Europe, and to some extent the US as well. So when the dust settles down on this Middle East issues, I would expect market attention to go back to demand, which exerts a downward pressure on crude prices.
Yeah, on that demand side, given the massive stimulus coming from China, what are the expectations that this will actually impact oil prices?
So I think the stimulus measures unveiled by the Beijing government, interest rate cuts, reserve requirement cuts for the banks, mortgage rate cuts, removing curbs for home buyers in 4 major cities, they have definitely perked up the equity markets. We see that, in fact, more than perked up, right? It's been a major rocketing of Chinese equities, but it hasn't translated to the oil market, and I'm not surprised, and I don't think it will. I think the oil market, because a lot of these measures are good for sentiment with regard to Chinese economy, but I think the oil market has now learned its lessons as well with regard to Chinese oil demand. It will actually wait to see these percolating, translating into actual Chinese crude import figures, actual Chinese end user fuel demand figures, which may take several months and produce a very small bump, if at all. Another thing to keep in mind in China, the decline in demand growth for oil is also a big factor of the move away from oil. So electric vehicles, passenger cars, and a lot of LNG used for trucks and buses. This is structural. This is for the foreseeable future. So that will also need to be factored in for the oil markets.
Vanda, always great to have you with us. Vanda, who's the founder of Vanda Insights there. Take a look at what we're watching in Australia. We do have the IMF coming out and saying that Australia will need to rein in its fiscal spending situation in the event that inflation fails to ease further. They're really countering the current government's claims that policies aren't impacting price pressures. They're talking about that pronounced personal income tax cut, new expenditure items, including broader support for cost of living issues expected to contribute to moving the budget to a deficit. This is in the IMF's concluding statement of its 2024 mission on Thursday. Energy rebates, some of the other measures could also inject additional stimulus effects on the broader economy. So this potentially comes as a bit of a blow to Treasurer Jim Chalmers. He's been, of course, insisting that increased spending isn't to blame for sticky prices. And Australia, of course, is contending with those sticky inflations, the last mile of returning inflation to that 2 to 3% inflation target from the RBA. And as a result, of course, we've seen the RBA really refraining from joining that global monetary policy easing cycle there. We're continuing to see a bit of downside there going into the start of cash trading here in Sydney. We've seen Australian bonds tracking treasuries lower. That's largely on account of reacting to that jobs report in the US, again prompting traders to pare back bets on more aggressive Fed rate cuts this year, and yields in this part of the world are following suit. More ahead on the Asia trade. This is Bloomberg.
OpenAI has completed a deal to raise $6.6 billion in new funding. This latest round takes the AI company's valuation near $160 billion. For more, let's bring in our tech reporter Annabelle Jewelers in Hong Kong. This was really one of the largest ever private investments.
Yeah, that's right. And it really vaults AI, or OpenAI rather, to one of the most valuable startups in the world. You're talking, putting it alongside SpaceX, for instance, TikTok owner ByteDance. But it just certainly tells you, to your point there, around one of the most valuable or highest ever valuation rounds, that the tech industry really believes in the power of AI. So some of the key details here. So it was led by the latest round by Thrive Capital. They tipped in around $1.3 billion. Microsoft Microsoft, we're hearing, which is, of course, the biggest backer to date, about $750 million. Others, including Khosla Ventures, Tiger Global. In Asia, we were reporting Softbank, for instance, or the information actually had this initially, but looking at handing over $500 million. So a lot of different really high-profile names. It's then a question of how does OpenAI plan to use this cash? And what we're hearing from the company, because they put out a statement, is that they're looking at putting the funds toward AI research, adding compute capacity as well, because that's becoming quite a key issue now, just having enough computing power to power these AI tools. But certainly a huge valuation, and one that's really transfixing many in Silicon Valley.
We have heard warnings when it comes to these kinds of sky-high valuations.
Yeah, that's right, Haidi. And actually one of the most read stories on our terminal over the past few hours is an interview that Bloomberg did with Daron Acemoglu. He is a renowned professor at MIT, and basically he's poured a lot of cold water over the potential of AI, because if you take a look at where AI stocks are trading, for instance, and this chart here puts it in perspective, you've got NVIDIA, the line in white, but then you're also looking at Meta and Broadcom there. The line in purple is the S&P 500, and it has really, of course, been outpaced by those AI-related themes. Pretty much every single industry is talking about job disruptions to a degree, and Acemoglu tells us that this is completely overblown. He's saying that at best, only 5% of jobs are set to be replaced by the technology. So then it's really a question of, okay, where does that mania you're seeing there go from here? He's seeing sort of three different scenarios here. One is that it slowly fades. Two, we see the frenzy building for another year or so, and then you've got a tech stock crash. And three, he says that companies could end up continuing to invest heavily in AI for years. It goes unchecked. They push through layoffs. They're only left scrambling to rehire staff when the technology doesn't go as expected. And so he's looking at a sort of a combination of 2 and 3 as being the most likely scenario here. Again, a bit of pessimism being added to the mix, but it is interesting to put what Acemoglu is saying against that story around OpenAI raising $6.6 billion at a valuation of near $160 billion as well.
And as well as in Hong Kong. Taking a look at some of the other stories that we're tracking this hour, and NVIDIA has expanded a partnership with technology consultant Accenture to boost corporate use of artificial intelligence. The arrangement will see Accenture creating a new unit to help clients use generative AI. Accenture accredited its most recently quarterly earnings beat to strong demand for its help in deploying generative AI. LVMH and Formula One have signed a major sponsorship deal potentially worth $1 billion. The French luxury goods group will take over from Rolex in a 10-year-long partnership sponsoring races from 2025. The announcement confirms a Bloomberg News report last month of an imminent deal. Miami Dolphins owner Stephen Ross is said to be in advanced talks with private equity firm Ares Management and Alibaba Group chairman Joe Tsai to sell stakes in the NFL team. Sources say the deals include other assets and could be valued at $8.1 billion. We're told Ares would purchase a 10% stake, while Tsai, who owns the NBL's Brooklyn Nets, will buy 3% through his family office, Blue Pool Capital. More ahead here on the Asia Trade. This is Bloomberg. Well, Tesla posted its first increase in quarterly vehicle sales this year. However, investors were expecting more after China boosted EV subsidies. Deliveries rose 6.4%, but came up over 1,000 units shy of analyst estimates. Bloomberg's global business Asia editor, Peter Voko, joins us now. So the market reaction was so negative.
Yeah, it was. But I think if you dig below the numbers, like it was only a slight miss, about 1,000. And those consensus estimates had been sort of bumped up in the last few days before the numbers came out. But if you dig below the numbers a little bit, there's still some worrying signs there for Tesla. Sales have been pretty flat since essentially the beginning of 2023. And I think there was also an expectation here from investors that they were hoping for a bit of a surprise, looking for something that was a bit better than expected. For Tesla to reach consensus annual forecast for the year, it has to sell a record 499,000 vehicles this quarter, which would be a stretch. And also that would still make this year's sales lower than last year's sales, and they've been discounting a lot as well, so the margin isn't there for Tesla. I think the other thing is that people were hoping for a bit of a bounce from China, where we've had a cash for clunkers scheme introduced in the last quarter. So basically a subsidy trade-in when you trade in an old car for a new EV. That doesn't seem to have come through. And I think that just shows how much competition Tesla is facing in China, which is a key market for it. We saw earlier this week, BYD had a record 400,000 monthly sales of EVs and hybrids. And then other companies like NIO are coming out with SUVs that are competitively priced against the Model Y. So I think, you know, the China story just isn't holding up there for Tesla quite as people were hoping.
And it's robo-taxi day next week.
Yeah, and this is going to be major for Tesla now. You know, Musk has been talking this up for months. We've already had it delayed from August into October. You know, Tesla trades at something like 99 times forward earnings estimates, which is just off the charts. And a lot of that is around this idea that it's not an automaker, it's an AI company, that Musk is going to solve self-driving and autonomy. So they really need to hit it next week. And I think people are really going to be looking like, what are we going to get? Are we going to get an actual self-driving taxi that's ready to be deployed in US cities? Because if we don't get that and we just get some kind of concept or a prototype or a plan, you know, I think we could really see Tesla shares take a hit on that.
Well, there's Peter Verko there with the latest on Tesla. Let's stay with automakers. U.S. sales for Stellantis plunged 20% last quarter, the fifth consecutive decline. The car maker's been struggling to tame bloated inventories amid high interest rates and softening consumer demand. U.S. sales in the period were just over 305,000, the lowest since the company was formed from the 2021 merger of Fiat Chrysler and France's PSA Group. Toyota is delaying the production of its first U.S.-made electric vehicle until 2026. The spokesman says the start date for building a battery-powered SUV in Kentucky has slipped by a few months from the original target date of late next year. The Japanese giant also says it plans to sell as many as 7 all-electric vehicles in the U.S. within the next 2 years. Chinese automaker Xpeng is looking at several options to produce more of its cars in Europe. That's ahead of an expected EU vote on definitive tariffs on Chinese EVs. Vice Chairman and Co-President Brian Gu tells Bloomberg that they're looking at contract manufacturing and working with existing plans.
I think as a company, I feel like we have to be prepared to deal with whatever happens in this market. That means that maybe we have to think about our pricing, think about our product strategy, think about our business model to deal with such changes. All that I think are something we have to think through as a company.
And have you had any dialogue with sort of officials? Are you hearing anything from them in terms of kind of the approach?
Well, I think we do not hear anything more from what you hear in the market. Yeah. I think we're obviously waiting to hear the final results of the vote. But I think we see what's coming, and as a company, I think we have plans to deal with whatever comes our way.
Right, and one of the questions I think that this naturally leads to is thinking about local production, getting within the sort of tariff wall, if indeed they come to pass. Is that something that you're looking more seriously at? And if so, are there sort of locations that seem to you more favorable at the moment within the EU and the trade barriers?
Well, I have to say, being more local is not because tariff. It's not only because tariff. Because as a company has aspired to be a leader in a market like Europe, we have to think about becoming more local. We have to have more local team to build our local brand, and also have more local presence. And also, you cannot rely on export-only strategy to deal with a local market like such a big market like Europe. So having manufacturing options is something I think in the long run will always gonna be necessary. But what form does it take? What timetable does it take? Obviously, it's something that we need to deal with.
Are you beginning to think about where it might make sense? Have you spoken to officials? Are there places that are making it kind of welcoming for you to consider creating operations there locally?
Well, we are looking at multiple options, ranging from contract manufacturing to working with existing plants or even thinking about plants. But those are, I would say, still very preliminary. At the same time, I think it's also something that, as a young company, we need to understand better before we act.
And do you think that kind of flipping the model that happened in China, where you had joint ventures with Western automakers going in there, do you think you could see something like that happening in Europe? Because I also think, obviously, you have that partnership with Volkswagen. Could you kind of flip that partnership over here in Europe?
Well, I think it's all on the table because I think as a company try to develop local presence, having partner is a must.
Yeah.
I don't believe in acting alone. So just like what China market has illustrated, having strong partners locally allows you navigate some of the local difficulties and also provide efficiency as someone. So these are all options that we're examining.
Do you think that the U.S. market will ever be open to Xpeng, or is this something that is so far in the distance that you don't even really think about it?
Well, U.S. market is a very important market.
Yeah.
I mean, it's one of the largest EV markets, and also I think also a market that's ripe for technology innovation. But at the time right now, I think the policy is evolving and also making challenging for Chinese companies to enter. So we're looking at it very closely, but we're not taking near-term decisions.
Right. Do you think that a President Kamala Harris would make that more likely, potentially, down the line? Or do you see both candidates as kind of having the same impact in terms of kind of being able to do business for a Chinese company in the U.S.?
Well, we don't have a view on who is the right person or the policies, but I think we'll work with whatever policies that come along.
We're looking ahead to the Japan market opens at the moment. We are seeing futures pointing to the upside. We could see Japanese stocks rebounding after that fall of more than 2% in the previous session, with the Japanese yen seeing its worst day since June of 2022. A lot to do with the fact that we're getting confirmation from both the new Japanese government and the Bank of Japan that they're in no rush to hike rates. The new Shigeru Ishiba cabinet having an approval rate of more than 50%, both in the Yomiuri and Nikkei poll, 46% for the Asahi poll. Of course, we are expecting the general elections now on October 27th. We have the market opens in Sydney and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. And Haidi, we're on yen watch again after the worst day against the U.S. dollar since June of 2022. A lot to do with more confirmation from the new government and the central bank that they're on the same page when it comes to not rushing to hike rates. But the labor market data that we've been getting from the U.S., especially given that we're headed to those non-farm payrolls, very, very key right now.
And it's happening at a time, Shery, where we see escalated geopolitical tensions, right? We're seeing the US, G7 allies really kind of trying to tamp down any further escalation of this exchange of, retaliatory action between Israel and Iran and Hezbollah. It's quite interesting that you are seeing that underperformance of the yen in this environment.
Yeah, we'll continue to watch that 146 level because it was really interesting when we got the latest comments by the new prime minister about really Japan not being ready yet for more rate hikes. We saw the yen go towards that 144 level and then shooting up to that 146 level after the U.S. ADP private payroll surprised to the upside. So we're seeing upside when it comes to Japanese equity markets. We'll be watching those exporters, of course, today that could benefit from a weaker Japanese yen. We'll also be watching Softbank today, having participated in the latest round of funding for OpenAI. We had JGB yields under pressure for the last two sessions, but of course, a whole different picture with the Treasury space overnight, given the labor market data. So we'll continue to watch the latest moves in JGB yields, Heidi.
Yeah, take a look at how we're setting up when it comes to just the first really minute of the cash trading session here in Australia. We're seeing a little bit of weakness in that futures session. And of course, treasuries are really leading the way lower when it comes to Australian bonds as well, with that big move in yields here in Australia. Sydney futures are actually seeing a little bit of a climb at the open, about 0.1% there, as we continue to watch, in particular, whether we see this further leg higher for the likes of these industrial and base commodities, right? Iron ore continuing to rally on these home easing rules from China. Even with China now in the middle of that week-long holiday, we're still seeing the impact of those stimulus measures and the fiscal easing measures as well really play out. The Aussie dollar is unchanged at the moment at 68.84. We have had an interesting sort of warning from the International Monetary Fund saying that the country really needs to rein in fiscal spending in the event that inflation fails to ease further. So perhaps giving a little bit of sort of food for thought for both the RBA and the government. The government, of course, in particular, has really pushed back on the idea that a fiscal policy has been a major contributor to the stickiness of inflation. And that is, of course, why we see the RBA basically on that hawkish hold until it gets more sustainably towards that 2 to 3% inflation target. Take a look at treasuries as well, because we did see that reassessment of what we could see from the Fed, bonds slipping as that promise of the second big Fed cut was really curbed on the back of those jobs numbers overnight. Our next guest says investors should brace themselves for heightened volatility as global conflicts rage, the US election approaches. Joining us now from Jakarta is David Chao, who's a global market strategist for Asia Pacific at Invesco. David, great to have you with us. And, you know, markets have been typically pretty good at shrugging off geopolitical risk. And even we know that history would tell us that in the aftermath of a US election, regardless of who, emerges victorious, if you will, US markets will continue to rally. So what risks are you looking out for at the moment?
Good morning. Yes, I do think that geopolitical risks and U.S. presidential risks are more of a near-term phenomenon, but it is something that we have to keep an eye on because there is a chance that it could devolve into policy uncertainties for the rest of Asia. I think that APAC markets are more impacted, say, by geopolitical risks in the Middle East and also U.S. elections because much of APAC imports oil. And also, given the tariff differences in policy uncertainties under a potential Trump White House, certainly APAC markets and economies would be impacted.
Where do you see the beneficiaries at the moment? Because obviously we're still sort of watching to see if this rally, this real turnaround for Chinese assets is going to be a sustainable one. Do you think this is a false dawn and a lot of this has to do sort of coming off the super low valuations, or do you think fundamentally there is a shift in how these assets are being valued by the market now?
Sure. I think heading into the last quarter of the year, a lot of other comparable assets such as developed market equities seem very full, if not frothy at certain levels. Yields also came down pretty meaningfully. So many investors were looking at places of value or which assets to own. And I think that Chinese equities certainly became the very plat du jour because of this significant stimulus, because it was underowned over the past few years. That really created an environment of FOMO, of fear of missing out. So I think at this point, many foreign investors who have been sitting on the sideline are very much thinking whether to jump in or not. We think that the rally can still be sustained because there's more fiscal stimulus coming along the way. We haven't seen the benefits yet. And I think that there are positive catalysts for Chinese equities.
David, are you bracing yourself for the non-farm payrolls tomorrow out of the U.S.? I mean, given the conflicting labor market data and the increased focus by the Fed on the supposedly weakening labor market conditions in the U.S., how big of a catalyst could this be for global markets tomorrow?
I don't think it's such a big catalyst, given I think that the narrative has certainly moved from a faltering U.S. economy. And now the narrative is very much on how many rate cuts we're going to get from now until the end of the year. I think the U.S. economy, as characterized by Jay Powell recently, continues to be quite resilient and robust. So I don't think that 1 month's payroll data is really going to move the needle.
And yet we're seeing the Japanese yen seeing the worst day since 2022, especially given that also at the same time you have more dovish signals coming from the new administration, coming from the BOJ as well. Will these moves, especially sharp moves in the Japanese currency, could that be a risk?
Well, I think that the moves from the Japanese currency were very much based on potential policy continuity, questions over policy continuity in Japan under the new Japanese administration, and the administration's direction towards monetary policy. It seems that there continues to be a bit of uncertainty as to who's going to be in what positions in the cabinet and in the ministry for Japan. And I think that until then, there could be a bit of volatility. Now, the Japanese yen benefits in the sense that we continue to see global easing among major developed banks. And that certainly gives the BOJ more wiggle room. So I think that any kind of market volatility for the Japanese yen is likely to die down in the coming months.
How much wiggle room do emerging economies have? I know you're in Jakarta right now, and we have seen that slump in the rupiah, the Bank Indonesia having to act. What does this mean for really smaller economies and smaller markets?
It should be a pretty good year, I think, for local currencies and local risk assets in EM. Developed market, assets continue to appear very expensive at these levels. And I think that as central banks start to ease, that EM equities, EM currencies are likely to benefit. We've already started to see that in the past month, and especially with China taking the lead at this point. I think that this could be the year that EM finally outperforms developed markets.
I'll hold you to that. I mean, we've heard about that for a while, and it's always been unsustainable. But David Chao, global market strategist for Asia Pacific at Invesco, with his views on the broader markets right now, as we're seeing Japanese assets gaining ground. The equity markets right now, the Nikkei rising more than 2.5%, of course, a function of a weakening Japanese currency at the moment, but we're seeing that 146 level being sustained. We are watching those exporters very closely. Tech, one of the big gainers today, real estate, communication services, every sector right now in the Japanese equity markets is in the green, especially after that fall of more than 2% in the previous session. But it's really the function of the Japanese yen and where this goes from here, and what non-farm payrolls in the U.S. will mean for the Fed trajectory that we're watching very closely as well. We have more ahead on the Asia trade. This is Bloomberg.
Iran's missile strike were a necessary and proportionate response to Israeli continued terrorist aggressive acts over the past 2 months. The regime is pushing the region to the edge of an all-out unprecedented catastrophe. Israel has no intention to pursue peace or a ceasefire.
Iran's ambassador to the United Nations speaking at the Security Council. Take a look at what we're watching across broad commodities. And of course, when it comes to base metals, we are seeing the bulk of those gains across iron ore and copper really being held, even with China now in the middle of its week-long holiday. We're still seeing that positive reaction to the stimulus measures and the loosening of the home buying restrictions across those tier 1 cities. But of course, the big focus today continues to be on oil and energy markets, given these escalating developments in the Middle East. We're seeing Brent crude trading just under $75 a barrel at the moment. Traders, though, are increasingly betting on $100 a barrel oil as these risks escalate, seeing these crude options looking like they're betting on paying out if prices rally to $100 a barrel. So kind of some hedging against the growing risks there that we're seeing in that market. Well, Bloomberg's Michael Heath has been following developments in the Middle East and joins us now. So what are we sort of waiting for? Because we see at this point both the US and G7 members trying to do what they can, and maybe that's a limited amount of influence at this point to settle these tensions.
Yeah, well, I mean, Haidi, I guess the main issue now is how Israel responds to Iran's missile attack. I mean, Iran's already done this in April. the US managed to talk Israel down to a fairly limited strike. And the reason for that was that Iran telegraphed fairly clearly what it was going to do. It gave everyone time to put in place anti-missile defences. It didn't use its fastest or best missiles, so it was almost demonstrative, and it made it clear that that was the case. Israel responded quite cleverly, in fact. It was a pinpoint target, but it managed to go quite close to a fairly sensitive area of Iran, which sort of showed we can get to you. And that was that. Now, this is a totally different kettle of fish, because really it was only the US that alerted Israel that Iran is about to do this. They will launch an attack. They were much more significant, much more dangerous missiles, basically. I mean, all missiles are dangerous, but these ones were much more sophisticated. And Israel didn't shoot them all down. I mean, some did hit bases. Israel says they didn't do damage, but the chances of people being killed are high, as they are in any war. But this is basically a state-to-state attack. And so Israel, on one hand, it needs to respond because it has to show deterrence. But on the other hand, it just, this is not a game. I mean, if Iran is going to attack over, saying that it's responding because of what's happening in Lebanon with Hezbollah, well, it's not really acceptable. So Israel has to respond. The question is, what does it do? There's talk that it attacks perhaps Iran's energy infrastructure. The great worry is its nuclear facilities. So that's what the US and the G7 are about, and I think the US will be putting a lot of pressure on Israel there.
And on that last point, is there an assessment of the real risk that Iran might think, well, if an attack on its nuclear facilities is imminent, is this the time to be weaponising that nuclear program?
That's exactly the great worry. Yeah, I mean, look, if Israel overplays its hand here, we could find, that Iran does accelerate that process. And the general perception is they're not that far off, and if they do commit to it, they could probably do it reasonably quickly. And this is just a reality for all these countries that are sort of outside the Western order. I mean, sorry, outside of the global order, Western order, if you want to call it that. And let's be honest about it. But that once you have nuclear arms, you are protected from these sort of things. And Iran has sat very close there. But it's just such a dilemma. Israel must respond, but it must be calculated in this. And this is just such dangerous territory. And what you're talking about markets, it's just the nerves that are going on there, because a miscalculation here, or a piece of military equipment doesn't work properly or something like that, and we could find ourselves in a regional war quite easily.
What's next here? What are we seeing in terms of mediation efforts? Well,
Shery, obviously President Biden is speaking with Prime Minister Netanyahu, and we've had the G7. I mean, the G7's looking to put members of the G7 looking to put more sanctions on Iran as well. I mean, they're sort of calling it for what it is, that this is one state attacking another, and that's unacceptable kind of thing. And whatever's happening in Lebanon with Hezbollah is irrelevant to this. So look, we're just going to have to wait and see. But I suspect it's not even going to be just the US. I suspect that Europe. I suspect that you'll probably have China and Russia looking to get in Iran's ear too. No one wins from this escalating into a regional war. I mean, if Israel miscalculates, Iran comes back, and those two end up in a war, the US must intervene. Then what do Russia and China do? I mean, it would just be a terrible mess. And let's not even talk about the civilian casualties or the suffering. So everybody's got a stake in trying to talk Israel and Iran down, but Israel will have to respond in some way.
Bloomberg's Michael Heath there with the latest on the Middle East crisis. And this as we continue to see Brent prices up for a fifth consecutive session. In the Asian session today, we're talking about the highest levels in about a month. Our senior energy reporter, Steven Stepchinsky, joins us now on what's driving the market moves. Steve, of course, we have the geopolitical tensions really giving rise to fears of supply. But at the same time, we're still swelling U.S. stockpiles. So what really is driving these moves right now?
Yeah, I mean, I think when you look at the market, if you strip out this geopolitical situation, the market is bearish. Oil has dropped over the last few months from around $90 Brent to about the $70 level. Then it jumped up in the last few days to about $74 because of the geopolitical risk premium. So while the market is well supplied, while there is no impact on export or production of oil, and while demand in places like the U.S. and even China after the stimulus is not looking as strong as some of the market folks had hoped, or some of the traders had hoped months back, we are seeing this gain because of the risk that was highlighted just before this. Is Israel going to strike Iran's oil production facilities? Will they take another step to hit their nuclear-related facilities? If they hit oil, there are some banks suggesting that it could take out about 1.5 million barrels a day of production from Iran. That's about 1% of global oil supply. Now, it might not seem like a lot, but that would, of course, increase oil prices because then that cat is out of the bag. There's been attacks in the Middle East on oil production, and oil production in the Middle East makes up about a third of the global market. So how does it escalate from there? Then you're going to see people trying to hedge their bets, looking at different options, and prices will continue to rise. If nuclear facilities are hit, well, that doesn't affect oil exactly. That is an escalation that could see a wider spiral. So those are the two main points that the oil market will be watching very closely over the next few days.
And you're already seeing the Brent 100 oil calls being traded, right? At this point, are these sort of, insurance policies? Is it more of an outlier view, do you think, or is it kind of increasingly showing that there are significant parts of the market that are hedging for these sorts of worst-case scenarios?
I think it is really just a hedging your bets against an absolute worst-case scenario. If you look at the fundamentals, $100 oil doesn't make much sense. And when you're also trying to predict geopolitical situations, it's impossible, right? No one knows what Israel is going to do. You can have an inclination, you can have a fear, and so these call options are likely just insurance policies. Maybe people are covering shorts that they had previously, so they had to buy them. I wouldn't read too much into it. I think it does indicate that there are people who are nervous in the market. And when people are nervous, they buy things like this, they hedge, or prices become more volatile.
What did we see in terms of price moves when we had the blitz of Chinese stimulus? Right now, away on Golden Week holidays, but how much of that demand potential is being factored in?
I think when you look at the oil market versus metals, there's a bit of a disconnect. I think certainly the metals market, which is heavily, China is a huge consumer of iron ore, copper, and the like. When you saw that stimulus, you saw prices rise quite significantly after that announcement. Oil, of course, did see a bit of an uptick, but I think overall, it's not just a demand story, it's a supply story. And OPEC Plus is bringing barrels to the market. They confirmed it in a meeting yesterday. And you're also seeing U.S. shale production quite resilient despite the drop in prices. So even if you are seeing a stronger China, that doesn't change the fact that oil demand is going to be outstripped by supply, and likely there will be an oversupply for 2025, according to the analysts that have been publishing notes over the last few weeks.
Stephen Stupczynski, good to have you with us, our senior energy reporter, with what we're seeing in the commodity space. And these are some of the other stories that we're following right now. The U.S. Central Intelligence Agency is boosting efforts to recruit Chinese citizens. The agency hopes to capitalize on what officials say is growing discontent with President Xi Jinping. The CIA has issued Chinese language instructions on social media, detailing how people can securely contact it on its public and dark websites. The move comes as Washington struggles to gain insights on Xi's inner circle. Canada says it's working with Nordic countries to create a new Arctic security coalition. Foreign Minister Melanie Joly told Bloomberg the talks are needed because the northern allies don't meet at the political level anymore, partly due to Russia's presence on the Arctic Council. Joly says the Russia-Ukraine war and China's interest in the far north are a new reality for Canada. We have more ahead on the Asia Trade. This is Bloomberg.
This is the Asia Trade, the corporate stories that we're following. NVIDIA has expanded a partnership with the technology consultant Accenture to boost corporate use of artificial intelligence. The arrangement will see Accenture create a new unit to help clients use generative AI. Accenture has already invested heavily in the new technology and has credited its most recent quarterly earnings beat to strong demand for its help in deploying generative AI. Miami Dolphins owner Stephen Ross is said to be in advanced talks with private equity firm Ares Management and Alibaba Group chairman Joe Tsai to sell stakes in the NFL team. Sources say the deals include other assets and could be valued at $8.1 billion. We're told that Ares would purchase a 10% stake, while Tsai, who owns the NBA's Brooklyn Nets, will buy 3% through his family office, Blue Pool Capital. LVMH and the organisers of the Formula One races have signed a major sponsorship deal potentially worth $1 billion. The French luxury goods group will take over from Rolex in this 10-year-long partnership. LVMH will start sponsoring races from 2025 with brands including Louis Vuitton, Moët Hennessy and Tag Heuer. The deal is a blow to Rolex and signals LVMH's bid to capture the boom in sports investment. Well, of course, luxury has been really seeing a moment in the sun when it comes to the reaction in European stocks to the China stimulus story. But we are seeing broader downside when it comes to trading in Euro Stoxx 50 futures at the moment. DAX futures are also showing a little bit of a weakness there. We saw a pretty muted session in the previous Wednesday session, really weighed down in terms of sentiment by these escalating tensions in the Middle East. Oil price gains have been lifting energy stocks as well as some of those miners that continue to see gains across copper and iron ore prices on the back of the China story there as well. Watching retailers on the sort of more affordable end, JD Sports saw a decline on the Nike story after Nike reported a drop in quarterly sales. And of course, we continue to watch some of those defense stocks as well, given these escalating the situation in the Middle East. So watching the likes of Saab, AB and Rheinmetall AG in the session. Shery.
And Haidi, we're watching sovereign bonds right now because treasuries continue to lose ground at the moment, really pressured after that stronger than expected jobs numbers that we got when it came to the ADP private payrolls rising more than expected. So 10-year yields now are very close to that 3.8% level. And it's a similar picture across Asia right now. In fact, when it comes to the Australian yield curve, we're seeing really yields rising across the Australian sovereign yield curve really early in the morning session. Not a lot of movement when it comes to the JGB space, given that we are also contending with a tricky 10-year bond auction today. But really key to watch in the next 24 hours will be the non-farm payrolls in the U.S. and what that really tells us about the strength of the labor market and where the Fed goes from here. We have more ahead on the Asia Trade. This is Bloomberg.
We are just getting Singapore PMI numbers crossing the Bloomberg, of course. Always a very interesting reading given how externally exposed Singapore's economy is. And we are just getting that reading through when it comes to the PMI numbers at the moment. The whole PMI number, that reading there coming in at 56.6. The index had fallen to 56.6 from the prior reading of 57.6, I should say, in August, a year ago. So still an improvement, which was at 54.2. Output, though, continuing to see those declines and quite a significant decline, falling to the lowest reading since April 2024. Shery, we're also seeing new orders falling versus the prior month as well.
A little bit of falling when it comes to the Jibun Bank Japan PMI composite for the final numbers of September. We're at 52 at the moment, but this, of course, is still in expansionary territory for a third consecutive month. When it comes to the services, Jibun Bank PMI as well, 53.1 is a final number for September. Take a look at how Asian markets are trading at the moment, because it's really all to do with the Japanese stock market right now. We continue to see those gains on the Nikkei of more than 2%, given, of course, the weakening of the Japanese yen at that 147 level at the moment. And this coming, of course, from that divergence that we continue to see, whether it's the BOJ not rushing to hike rates or the Fed not rushing to cut rates. The Apollo CEO, Marc Rowan, says he doesn't see a reason for the Fed to keep cutting interest rates right now, warning the U.S. economy risks becoming overstimulated. Speaking exclusively with Bloomberg, Rowan also outlined his concerns about economic management ahead of the presidential election.
The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
Do you see anyone on the campaign trail that's willing to do anything about that?
On the campaign trail, no.
In reality?
Let's hope. All we can hope for is better governance.
I've said repeatedly on Bloomberg surveillance, on Bloomberg TV, on Bloomberg radio for years that America has the privilege, the unique privilege of acting recklessly. Are we losing that?
Not yet. We have a long way to go. We have lots of examples around the globe of people who have acted recklessly for a much longer period of time than we have been acting recklessly. But we also have obligations that others do not. Right now, we are the beneficiary of being the strongest economy, the strongest capital market, the strongest military, and the best place to do business. I mean, if you tick off what's happened over the past years here, we may not like how we got here and how we financed it. 3 years ago, we decided to build infrastructure. We allocated $2 trillion. None of that's built yet. It's all being built. 2 years ago, we spent $52 billion of semiconductor subsidies to build semiconductors here. Not a single plant is open. It's all being built. A year ago, Inflation Reduction Act to encourage the manufacture of renewables. 1.3 to 2.3 trillion. No one really knows. Not a single plant is opened. We are the beneficiary and the largest recipient of foreign direct investment 3 years in a row. So people around the globe are actually figuring out we're better off here. And something tells me we're ramping defense production. All of those things are fiscally stimulative and positive for employment. Oh, by the way, we have no illegal immigration. This sets us up very well fiscally for a strong economy, which I think we're seeing.
Federal Reserve is cutting interest rates by 50 basis points. Are you in Torsten's lot camp? And you can agree or disagree with Torsten, of course. Torsten works here. He believes this economy doesn't need rate cuts. We're in a great place. Do you share that view?
I said it right. I was, I guess, unfortunate to be on TV an hour after the rate cut. And I said this was a very, very expensive insurance policy.
What's expensive about it?
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet we're stimulating. And we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time. And to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter, to the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now.
Apollo CEO Marc Rowan speaking exclusively with our colleague Jonathan Ferro. Time now for morning calls ahead of the Asia trading day as we get into broader markets, of course. We've seen major markets now online for about half an hour. Scott Rubner of Goldman Sachs says a rally in US stocks may push the S&P 500 above his own year-end target of 6,000. The firm's managing director for global markets says his target may be too low as seasonal headwinds fade and stocks tend to rally after the US presidential elections. Rubner adds that he remains tactically bearish when it comes to US equities, though, over the next 3 weeks. Bank of America's Bernard Mensah says interest rates in many parts of the world won't likely return to pre-pandemic levels. He's citing challenges plaguing the global economy, such as geopolitical conflicts and changes in supply chains. Mensah says economies need to focus on long-term trend growth instead of just relying on monetary policy.
I personally have been worried about just the underlying inflationary pressures that are out there for a bunch of reasons, whether it's COVID, whether it's supply chain moves, and the inflation shocks going through the economy. We have the port strikes in the US that are happening now, and we have increased wage demands. My instinct has been that all of those things add inefficiencies in the system, and as we're moving to a different, perhaps, type of globalization, that we might find that the underlying trend inflation rate is a little bit higher.
Now, stockbrokers in Hong Kong are having one of their busiest periods, with some describing the current rally as a once-in-a-century event. Hedge funds betting big on China also scored returns of more than 25% in September, according to Bloomberg sources. For more, let's bring in our China correspondent, Min Lo. Min, so FOMO, animal spirits, back in the Chinese markets?
Yes, Shery, we came into this Golden Week holiday wondering whether that momentum will fizzle out after the break, but Hong Kong market reopened yesterday after the National Day holiday and came back roaring. I'm talking about the biggest single-day gain since November 2022, 6.2% on the Hang Seng Index. The Hang Seng China as well soaring some 7%. And overnight, that momentum from the U.S., the Nasdaq Golden Dragon was also up some 2.5%. It seems like this rally will keep going for another few more months, according to some analysts, and investors are saying they're not even stock picking right now. They're just looking to gain exposure to China. And the big stars are really the real estate developers. The Bloomberg index tracking that it was up some 47% yesterday. That's the biggest on record so far. And I'm talking about those developers that have defaulted before, like Shimao. They're also seeing their share prices double over the past few days. Even the penny stocks soaring some 400% on the back of this speculative trading. And brokerages here in Hong Kong are saying they're still seeing that massive jump in new account openings, with some staffers cancelling their planned holidays to stand by 24 hours to cater to client inquiries.
We've seen outflows from other Asian markets, right? Is this because of a global portfolio shift back into China?
Yeah, we are seeing a little bit like an early sign of that right now, because last week we saw outflows from markets like South Korea, Malaysia, Indonesia, Thailand. And if this trend continues, it could put an end to that so far stellar performance of the Asia ex-China equity market so far. And certainly valuations really help, because even after that rally we've seen, China's stocks are still trading at below 11 times forward earnings, which is below their 5-year average so far. So there's still a bit of room to run, and valuations as well still 40% below the peak in 2021. And we also got pretty upbeat data from the first day of the October National Day holidays. The railway passenger trips was 21 million, I believe. It's the biggest on record so far. So that's an early indicator that maybe Chinese consumers could be coming back in force this Golden Week holiday as well.
Bloomberg's China correspondent Min Lo there. More ahead on the Asia trade. This is Bloomberg. OpenAI has completed a deal to raise $6.6 billion in new funding. This latest round takes the AI company's valuation close to $160 billion. Let's bring our tech reporter Annabelle Drewlers, who joins us in Hong Kong. And Belle, OpenAI, well and truly one of the most valuable startups in the world.
Yeah, Heidi, you're talking about a top 3 at this point in time, alongside the likes of SpaceX and then also TikTok owner ByteDance. It just certainly tells us how much the broader tech industry believes in the future of AI, and just some of the key details in this. So the latest funding round for OpenAI was led by Thrive Capital. They tipped in about $1.3 billion. We're talking about that aggregate $6.6 billion. Microsoft, we're also hearing, contributed to this to the tune of $750 million. Of course, they have been one of the biggest, or the biggest backer to date. Others include Khosla Ventures, Tiger Global in Asia, Softbank, for instance. The information earlier reported that $500 million was what Masayoshi Son was looking to invest into the company. So a lot of really different high-profile names that are involved here. The question, of course, is how does OpenAI plan to use so much money? They did actually put out a statement saying that the funds will go toward AI research and then also adding compute capacity. And that's really essential, because you do need to keep adding that compute capacity if you're going to keep or continue to power these ever-growing AI tools. So certainly a huge valuation, and one that we're hearing has really transfixed many across Silicon Valley.
Yeah, $157 billion. But we continue to hear all of these warnings when it comes to these sky-high valuations.
Yeah, it's quite an interesting day when you've got that story around OpenAI and then also this other one that's really shot up the readership charts. But essentially, Bloomberg spoke to Daron Acemoglu. He is a very renowned professor at MIT, and he's basically poured a lot of cold water on the promises of AI. And so it's really interesting, he says, when you take a look at those moves that we see in markets. I mean, this chart here, you're looking at those big gains we've had in NVIDIA, Broadcom, Meta. They're also the lines there in blue and yellow, and then versus what we see in purple, which is the S&P 500. And even though the S&P 500 has done well, it's certainly been outpaced by its peers in the tech space. Acemoglu is telling us that that kind of move that you're seeing in the markets is completely overblown. At best, when you're having these conversations in industries, how much or how many jobs are going to be displaced, he's saying only 5% are going to be disrupted by the technology. So then it's the question, of course, where does the mania go from here? And he's taking a look at 3 different scenarios. The first is that the hype slowly fades over time. The second is that the frenzy builds for another year or two, and then you've got a tech stock crash, given those valuations. And then the third, he says, is that companies continue to invest in AI heavily for years. They push through layoffs that only leaves them scrambling to rehire staff when the technology doesn't go as planned or panned. And he says that in that third scenario, which he sees as the most likely in combination with scenario 2, so a mixture of the 2 different ones, he's saying you're looking at widespread economic issues here. So yes, as we said, one of the most read stories on the day compared to what you see for OpenAI and just so many investors joining this latest round.
Annabelle Jewelers there in Hong Kong with the latest on that OpenAI funding round. And as Belle just mentioned, Softbank also said to be among the investors. We're expecting to actually hear from CEO Masayoshi Son shortly. Let's get more with Oliver Matthew, head of Asia Consumer at CLSA. Great to have you in the Tokyo studio. How big of a push is Softbank putting into AI, into semiconductors right now?
Well, for AI, I think they're on the AI elevator. So they're now at base level. And then Masayoshi Son has talked about going to AGI. And then ASI, which is, he's looking forward, I'd say, at least 15 years and thinking very seriously about the changes. Within that, you have semiconductors, which is going to be part of it. But he's already bet on 400 or more companies to benefit from various stages of AI. So he is all in AI across the board already.
Could we hear something new from today's Softbank event?
Softbank World. So I think you'll see 2 main presentations. One is from Mensah, and he will be explaining basically to corporate Japan, this is the future of AI. These are the things which are going to come your way, and that's the big vision. Then you will have Miyakawa-san, who's the head of Softbank Corp, who is actually helping implement those strategies for many Japanese companies, and he will be explaining in more detail, these are what we can help you with, and there'll be a lot of emphasis, I think, also on AI data centers, which is going to be a big push in Japan in the next few years.
When it comes to all of these new investments and driving to AI, is this the right time for Softbank, given that also other metrics like their net asset value, for example, the loans to value have actually come down, and we're seeing better numbers for this company?
So they have a lot of firepower. It's actually interesting, they've reduced their investments over the last couple of years. So what are they going to do next? How aggressive will they be driving the vision? And I think Mensah has spent a lot of time thinking the last 2 years. He hasn't been participating a lot with the market. He's been thinking, and gradually we're going to start seeing some of those initiatives. I think he made a big investment in Tempus, talking about medical AI. We heard about that. Now you have OpenAI. So we're starting to see some bigger tickets coming out. I think we'll see more going forward from Mensah for sure.
And Shery makes a good point, right? Does net asset value volatility and the potential downside risk create, a meaningful concern for Softbank, particularly if the valuation for ARM gets a bit of a reality check?
Yeah, ARM is their largest asset at the moment. So if that was to take a hit on valuations, that would definitely put a little bit more pressure on their ability to make new investments. But right now, they're still in a very comfortable place. They have a share buyback going on. They could certainly spend more capital to buy back their shares if they became cheaper. So I think overall they're in a very strong financial position right now.
What about the position of confidence and credibility, right? Obviously, they're, coming off the back of what has been a really challenging few years, some, investment missteps, some unfortunate market headwinds that have been at play there as well. Do you think there is a degree of caution going into this next kind of era of what they're going to be investing and backing?
Well, there's always a debate on the timing here. Many people thought Mensah overpaid for ARM. Turned out that was probably one of the best investments, of the last decade. So I think we should give him some credit for that. It's true, within the Vision Fund, they made a few bad investments. They've learned from those. But generally, I'd say he has an astoundingly good long-term track record. Short-term, there's some ups and downs, but he's done a very good job. Vision Fund, you've had a tough few years. If the US IPO market opens back up, now that rates are coming down, I think you'll find them in a very strong position. And don't forget, they're one of the largest investors in ByteDance, which is doing astoundingly well on the back of AI. So they've had some really strong home runs in their investments, as well as some of the more famous, shall we say, missteps.
We know that Mensah has a lot of conversations with Sam Altman. We know that there is that engagement going on. What further kind of developments would you be watching out for there, particularly in light of this sky-high valuation now for OpenAI?
Well, yeah, I think Mensah made it clear at the AGM. He discussed a much larger valuation with OpenAI previously, and they basically went with Microsoft. So OpenAI had a chance to really strongly partner. It looks like they passed. And so Softbank has looked at some other options. They've invested in Perplexity, which is being rolled out basically to all SoftBank users in Japan if they want it. That's a great service. So there are many other options for SoftBank just beyond OpenAI, but I think they're a strong match. The way they think should see them get on very well, and I'm sure that OpenAI will benefit from having a SoftBank investment in there as well.
What's the potential broadly for SoftBank of just rising digitization in Japan as well?
It's huge, which is the SoftBank World event today is part of that. Japan has a long way to go. You have declining demographics. You have companies still using fax machines. There is a massive amount of upside for proper digitalization here, and AI is going to speed that up. And SoftBank is one of the key enablers of that, because they've invested in so many of these global companies, bring them to Japan, make them successful. Probably the most famous one at the moment is PayPay, right? That was China, India, then come to Japan, big success. Suddenly payments for everyone are much better. You'll see more and more of these initiatives succeeding because of SoftBank.
I know. I keep getting asked to pay with PayPay, and I don't have the app. Oliver Matthew, good to have you with us, Head of Asia Consumer at CLSA. We have more ahead on the Asia Trade. This is Bloomberg.
This is the Asia Trade. The latest when it comes to automakers. Tesla has posted its first increase in quarterly vehicle sales this year, but investors were expecting more after China boosted EV subsidies. Deliveries rose 6.4% on year, but fell just short of the average estimate. The news coincides with rising expectations for an event next week when Tesla will unveil prototypes of its much-awaited robo-taxi. US sales for Stellantis plunged 20% last quarter, the fifth consecutive decline. The automaker has been struggling to tame bloated inventories amid high interest rates and softening consumer demand. US sales in the period were just over 305,000. That is the lowest since the company was formed from the 2021 merger of Fiat Chrysler and France's PSA Group. Toyota is delaying the production of its first US-made electric vehicle until 2026. A spokesman says a start date for building a battery-powered SUV in Kentucky has slipped by a few months from the original target date of late next year. The Japanese giant also says it plans to sell as many as 7 all-electric vehicles in the US within the next 2 years. Shery.
Now take a look at how those automakers are trading at the moment, given all of the news flow around car makers that you just mentioned. And Toyota, one of the leaders there, gaining about 2% and really reversing some of those losses that he saw in the previous session. Of course, it's really a matter of the broad rally in Japanese markets that we're seeing right now, right? The Nikkei is now gaining about 2% at the moment. A lot to do with what's happening with the Japanese yen as we continue to see that weakness headed towards that 147 level. Guys, if you can switch the board, you can see what Japanese stocks are doing at the moment, because you're seeing the topics also gaining about 1.2% and really reacting not only to the comments from the new prime minister on really Japan not being ready yet for further rate hikes, but also Governor Ueda seeming to be on the same page. And of course, on the other side of the trade, we have dollar strength given the upside surprises that we're getting on those labor data points. We do get the non-farm payrolls on Friday, Haidi.
Yeah, take a look at how we're setting up, Shery, when it comes to the futures trading session. Of course, China is still in the middle of that Golden Week holiday, but we're seeing still the impact when it comes to the stimulus-fueled rally and the recovery rally. That real turnaround story is starting to see signs of some of the outflows from other Asian markets that are perhaps being rotated by global portfolios into China assets. A relative performance when it comes to, for example, some of these Southeast Asian markets, Malaysia, Indonesia, Thailand, South Korea, all posted net outflows last week. BNP Paribas saying over 20 billion was withdrawn from Japanese equities in the first 3 weeks of September as well. At the same time, some of the analysis that we've done really shows that Chinese stocks are yet to match the earlier pivot rally. So we'll continue to watch for that when China markets reopen after the holiday. Also watching Taiwan trading, given that we've had that OpenAI valuation as well as the upside in Nvidia.